This video is going to bring out all the crazies. And so I'm warning you, if rabbit holes are not your thing, just move on, because we're going down a rabbit hole today on FDIC insurance. Now you may be thinking, Matt, what's the big deal? How's this a rabbit hole? FDIC insurance, super simple. I've seen all the signs at the bank. $250,000 insures my savings account, my checking account, my CDs, my money markets. I don't get it. What's the big deal? And yeah, that's basically it. You've got it. $250,000 on deposit is insured by the FDIC. But, I'm a person who likes to ask questions. So what does that even mean? That's where I started in this journey. What does that mean? Who is it that actually insures these deposits? And the answer I got was, well, the FDIC. Okay. Well, how? Where is the money? Well, the money is actually not with the FDIC. The money is with the Deposit Insurance Fund, DIF. Okay, the Deposit Insurance Fund operated by the FDIC. So far, so good. Makes sense. But, I've got more questions. This Deposit Insurance Fund, if it's insuring all these accounts at banks for up to $250,000, how much is that? Like, how many dollars are in accounts up to $250 that are technically insured? And this actually took some digging to find, but I did end up finding it. And it's with the FDIC.gov. You have to actually look at their quarterly financial statements, and they break all this information down for you. So here is that report. And we can see here at the end of 2023, this is December of 2023, the FDIC has $4.5 trillion that are technically insured. All right. $4.5 trillion insured. There's about $18 trillion in the total kind of depository banking system. So of the $18 to $19 trillion, $4.5 trillion is insured by the FDIC. All right, makes sense. I get it. But hang on a second. How much money then is in the Deposit Insurance Fund? If we know that there's $4.5 trillion that are insured, how much cash are they holding? How much do they have in this fund to pay on the insured deposits? And luckily, the same quarterly report actually tells us. So at the end of 2023, the Deposit Insurance Fund had a fund balance of $121 billion. That sounds like a lot, $121 billion. It's about 2.5% of the total insured deposits, the $4.5 trillion. So they're holding about 2.5% of the total insured assets. Now, of course, the total insured assets includes, every bank that the FDIC is covering. And so you wouldn't expect them to need to pay out on all of those funds because, not everything's going to blow up all at once, right? But I thought, what's the next best pin in the map? Like, where can we look to figure out how this deposit insurance fund actually operated during a banking crisis? And we actually have a really recent banking crisis, 2007 to 2010, depending on how you measure it, where we can look at the deposit insurance fund and what happened. So I went down that rabbit hole. I found a great article from the International Monetary Fund, the IMF, which we'll put in the description below in case you're interested in some light reading. It's about 28 pages. And there's a section, I'll show it to you here. There's a section on the U.S. Deposit Insurance Fund in the global financial crisis. And I love the way they put it because they give us the answers that we're looking for. So Deposit of Insurance Fund was more than fully depleted during the global financial crisis. I don't know what that means. If my bank account is more than fully depleted, what's the difference between that and depleted? Well, let's read on. While it stood at $52 billion or 1.2% of insured deposits prior to the crisis, it went into deficit as the number of banks closed or supported by the FDIC increased substantially. Interesting. Okay. So between January 2008 and September 2009, 120 U.S. banks failed. The most costly for the DIF or the Deposit Insurance Fund, is it DIF? Is it DIF? How do the cool kids say it? I don't know. We'll say diff. The diff being Indy Mac, 13.1 billion, Bank United, none of that matters. The deficit reached 8.2 billion. The deficit reached 8.2 billion by the end of September 2009. Okay, so then what did they do? If the diff is negative to the tune of $8.2 billion, how do they come back from that? Like, this is insurance, right? It's supposed to be deposit insurance. If the deposit insurance has a deficit, that seems to me to not be real insurance. That's something else. What is it? How do they fix it? Well, the FDIC was forced to substantially increase assessments. Okay, so they increased assessments on member banks during a time of financial stress. They also adopted several measures to restore the diff under a restoration plan in 2009, including applying a one-off mid-year assessment. So they applied a one-off mid-year assessment to member banks, and they made banks pay an estimated 3 years of deposit insurance in advance. So they opposed a one-off assessment, and they made member banks pay 3 years worth of deposit insurance in advance. So obviously that solved the problem, right? No, of course that didn't solve the problem. This article explains it. Those costs, the assessment and the 3 years, were dwarfed by the broader support provided by U.S. authorities to the financial sector during the financial crisis, including $434 billion of cumulative dispersals under the Troubled Asset Relief Program, which you know as TARP. So the FDIC imposed a mid-year assessment on banks and collected 3 years of insurance premiums, basically, for their deposit insurance up front. And those costs, what they collected there, was dwarfed by the TARP program provided by U.S. taxpayers. So those costs were dwarfed by TARP, but it goes even further than that. They also increased the FDIC's line of credit from the U.S. Treasury from $30 billion up to $100 billion. Are you guys catching where this is going? Because to me, this is a big, giant circle, right? You put money in a bank, you get FDIC insurance. Sounds great. Makes you feel all warm and fuzzy. $250,000 covered, baby. Okay. But if something goes wrong, is there money to pay? Not really. Not really. 2008 financial crisis, not enough there. Okay. Not enough there. Negative $8.2 billion. Well, then how did they pay it? The banks ponied up the money, right? Well, kind of, a little bit. But no, those bank premiums were dwarfed by what? By an infusion of dollars from the U.S. government and bolstered by a $100 billion line of credit from the Treasury. Interesting. This is interesting. Are you seeing why this is a circle? It's just a big, giant circle. You put in the money up to $250, you're insured. You think that you're just getting that for free. It's gravy, right? It's just to make you feel all nice and good. I actually like the way another article puts it. I'll put it up here on the screen. We'll link this in the description below. This is from the Congressional Research Service, and it's actually much more recent. It's from March 2023 after Silicon Valley failed. And if you're interested in kind of reading through that write-up, it's a great write-up. It's very short. It's only 3 pages, and it's very high level. But I like the way that they put it because they confirm some things we just read. So let's kind of dig in here. The FDIC is also authorized to impose any special assessments necessary. We just read that. They did that. So they're authorized to impose special assessments to maintain the diff or repay any amounts borrowed from Treasury. Okay, so there's that borrowing from the Treasury again, to manage the cost of a bank failure. Section 1824 allows the FDIC to borrow up to $100 billion from the Treasury. All right, so that line of credit that was like temporarily granted during the crisis, it's still around. This is from March of 2023, still a $100 billion line of credit from the Treasury, if needed to supplement the cost of bank failures. I love this last line because it completes the circle. In this sense, the DIF, the Deposit Insurance Fund, the DIF, is said to be backed by the full faith and credit of the U.S. government. And so I have one last question. It's an easy question. What is it that gives the U.S. government any faith or any credit? Who is it that gives the US government any faith or any credit, who is it? I'll wait. Who is it? It's the taxpayer. The taxpayer. It's you and it's me, because the US government has no faith and no credit outside of its ability to impose taxes on you and on me. This is why it's a full circle, because you're putting dollars in a bank, up to $250,000 FDIC insured. We've already seen through one banking crisis that there's actually not enough money in the deposit insurance fund to cover the total insured deposits by a wide margin. And there probably shouldn't be, right? I mean, they don't need $4.5 trillion in the deposit fund, but there wasn't enough to cover the last financial crisis we had. Was it a big one? Yeah. Do we have more debt than we did then? Yeah. Okay. So there's not enough money in the deposit insurance fund to cover the last banking crisis. It went into a negative $8.2 billion deficit. And who ultimately is the backstop for your $250,000 FDIC insurance? Who's the backstop? You are, and I am. The taxpayer in this country is the backstop for the very insurance that makes you feel all warm and fuzzy. And I just like to submit this to you. If you'd like to explore a different alternative where you're not the backstop for your own money, where someone else is the backstop, we would love to partner with you in that journey of exploring other options. And how you can do that is you can go to our website, leverageWM.com. Up at the top, you'll see book a meeting. You can go there and we'd love to chat with you. Our goal is to give you enough information and education to get you to a point where you feel comfortable making a good decision with your own money. We believe that you are absolutely capable of that. You can also check the description below. We'll have links there that'll just basically take you right to our calendar where you can book a quick discovery call with us. We can chat about what your goals are, and we can show you a way to get out of the system that says you're insured without telling you that actually you're the one doing the insuring. Hopefully this has been helpful. Until next time, take care.